everybody. Craig Moser here. It is the 8th day of November 2022. This year has blown by. Wanted to chat with you a little bit and just go over some data. Hopefully that will let you see kind of what's happening. One of the big things that I think that people are maybe getting overexcited about is that you're anticipating a big stock market rally. Now, there will be rallies, let me say that, but they won't be uptrends for a while. If we're headed into a recessionary period, which my personal belief is that we will, then you will probably see things be more stagnant. So one of the terms that you haven't seen in a long, long time is something called stagflation. If what I believe is going to happen, we're going to see periods of high inflation, mostly because we had to print a whole lot of money to get us out of COVID. COVID was a bad thing. And then the other side of it is now that all that money's in the system, it has to go somewhere. And then a couple of other things like oil prices are very high, which makes it hard to control from an inflationary standpoint, because the people that control that, mostly OPEC, decide what the price per barrel of oil is. So it's kind of weird. And then you throw on top of that sort of an interesting employment situation to where a lot of businesses cannot or are having difficulty in hiring people. And then on the other end of that, some of these businesses are starting to lay off, and it's just weird. You know, it's not a normal environment where, you know, you have unemployed people looking for jobs and so on and so forth. COVID changed a lot of that. So with that said, if we go into a period of stagflation, let me show you what that might look like on a chart. You know, I'm a chart guy, so I'm just going to show you a chart here, and hopefully this is going to give you an idea of a period where we had that. Now, 1963, I was a little kid, so I don't really remember any of that. But if you can see this right here, it looks very similar to what we had, you know, in 2020. We had a pretty good run up, 2019, a fairly significant drop, 2020, and then we had this huge run up in the market right in here. And then we had downs and ups and downs and ups and downs, and really no upward trend. Now, if you think, well, you probably don't remember, but if you can remember what happened in that period of time, we had high interest rates. They were raising rates to slow the high inflation rates that we had coming off of Vietnam and some other things like that. So, okay, but you see, looking at the Dow Jones Industrial Average here, we had peaks of 1,025 and bottoms of 577. There was some crashes in there, and as you can see, the market really made no progress. And a similar thing you could probably look at from 2000, the beginning of 2000, until the end of 2010. We just struggled in there. We had two back-to-back major market declines, and things were a little tough. They were. So it's not the end of the world as we know it. Money's not going away. What I am saying, though, is if you are thinking you're just going to get back into an upward trajectory, there are some things different now than there were, say, 8 years ago, 5 years ago in the markets. And I'll kind of go through some of the charts on that. But this is my fear, is that we're in here. So one of the things that you might start to consider is, how do we build yield into our portfolios? So in 2020, when we had the COVID pandemic, interest rates were, and I'm going to be generous here and say sub 0.5%, meaning when you did bonds or when you did CDs, you were making almost nothing. You know, 25 basis points, if that makes any sense, which is 0.25%, was sort of the norm back in 2020. Well, today I can get you north of 4.2% on a 10-year treasury bond, and even better on corporates. Now, I'm not saying you have to buy those. I'm giving those as examples. So now all of a sudden you're starting to get paid enough to make you at least take a good hard look. You know, should I do some corporates? Should I do some CDs? Should I do something else that actually generates a real return in my account I would caution you that mutual funds and ETFs go up and down a whole lot more than an individual bond or CD would. And the reason why is because the real bonds that you buy have a beginning and end date. So they're going to mature, which gives you a whole lot more control rather than a perpetually driven mutual fund, as an example. All right, so let's look at, if we can, some charts here. You'll sort of see the not really going anywhere world that I have to work in every day. So right here, this is the S&P gold shares. So this gives you the trend of shares. And if you're trying to figure out the price of gold, it's move the decimal one over. It's 1558.50 right now for an ounce of gold. And these gold shares are an easy way to buy them if you're looking for that. But anyway, gold peaked out right here. That was around March of 2020, and since then has been in a fairly significant slide. But from 12 months ago, 1 year, we're down 8.5, somewhere around that range. All right, let's look at what's up next. The bond market. This is going to be interesting for you. Bonds, my term for this is the flight path of a brick. When you look at this up and down green and red thing bouncing around, the price of the bond market, which this is pretty much the whole shebang in the United States, the bond aggregate. We use iShares Core US Aggregate Bond ETF as our proxy for that. But nonetheless, when you look at that, the price of bonds has gone down quite a bit. The yield has been fairly stubborn because all of the old bonds in here had lower yields. And so all of a sudden now we have stuff with higher yields competing, with this, and they have to drop the price down. Bond prices are down. Nothing wrong with the bonds. All right, let's look for a minute at emerging market. I'm just kind of already marked these up for you. So Russia, India, China are the big three in the emerging markets. And we're using, again, iShares Core, Morgan Stanley Citigroup Index, Emerging Markets ETF to give us what that chart looks like. So you can see a year ago, and now they're about 28%, 28.75, somewhere in that range, lower than they were 12 months ago. So that's a lot. I mean, if you had $1 million and you lost 28%, you lost $280,000. That hurts in the wallet, and you're worried about getting that money back. And the other part of that is what happens? How do I get that money back, and how long will it take me to get back to even's always a conversation. If we looked at that over a 5-year window, you can see that we're sort of where we were back here and lower than we were 5 years ago. So the emerging market index as a return animal has been very inconsistent. If you look at Europe, Australia, Far East, so that's Great Britain, France, Germany, all of those sorts of countries, Australia, Japan, Canada, they all fit in this index. So you can see up and down and up and down, and where we are is lower than we were 5 years ago. So people are concerned that we're not seeing any growth in the equity markets. And there's a whole another conversation about governments printing money and economic stimulus and blah, 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 blah. But if you're an investor, you're saying, I'm not making any money that I can hold on to. So it is a concern. If you look at NASDAQ. So what is NASDAQ? NASDAQ are the Teslas and Apples and Amazons and Comcast and Cisco. These are stocks in the NASDAQ right in here. They're not, this isn't just it, but these are some of the stocks in there. Google, Microsoft, yada, yada, yada. When you look at these guys and just say, okay, this group as a whole has dropped quite a bit. So if we look at just this last 12 months as our example, pretty dramatic drop, down about 30-some%, 34 from where it was 12 months ago. So again, $1 million, you lost 340 grand. That's starting to get your attention anyway. The stiff upper lip stuff may or may not work. We'll just have to see. But those stocks have declined in value. So depending on whether you're a glass half empty or glass half full person, you might be saying, hey, are these things now on sale, 34% less than they were, or are they going to continue to go down? And once once we've had some experience with this, we'll know. But when you look long term, you can see that we're down quite a bit from this market peak, which was insanely high. Right there was the highest point in the history of this entire index. So just kind of put that in the back of your hat, that the markets at the first of this year had never seen those highs before. And so now this correction sort of puts things back into a different perspective. Maybe we're not that far off track if you sort of drew a line here and kind of saw it visually. All right, S&P 500, did I already do that one? Might have, but let's do it anyway. So the S&P has a lot of good stuff in it. I mean, you have most of the Dow stocks, not all of them, but most of them. And you have the growth stocks. So you still have Tesla and Apple, but you also have Exxon and Wells Fargo in there to give you an idea that these companies, pretty much the strongest 500 in the world, in the country of the United States. So these are good companies, but again, as high as it's ever been. And the other side of that is, you know, when you kind of look at a trend and say, what is really a trend? We're not that bad off if we could just sort of understand what happened right here was a whole lot of money hitting the skids and trying to, find a place to call home. And so stocks were in there. That's kind of how it works. But short term, that's what most people pay attention to. There's a no moss thing going on here. We'll have to see if the markets get worse or better from here. The first of the year, right here is 12 months ago. So there's not a whole lot of good stuff happening in the stock or bond world right now. Gold's sort of lethargic. So just understand that maybe owning some things for the short term that actually pay you money might be good things to do. So we obviously are wanting to talk to folks about that. I'm talking to my clients now, but it's slow going because I have to explain everything to one person at a time if we're going to make changes in portfolios. But if you have questions and say, how can I get more real payments into my account and get you returns in the 5 to 8% range, that actually pay you and have an end date and mature, and we'll have to decide what we're doing with that money, then call me, 336-448-1086, and we'll work through some strategies and see if anything really fits for you. If not, no big deal, and we're here to help, and let us know. And so I'm going to stop with this, and hopefully you'll have a great November. Enjoy your Thanksgiving time with family and friends. Stay healthy, and we'll talk to you next month.